And so what those 38 CEOs have said in different terms is, we are CEOs of an industry that is totally global. We are CEOs that operate around the world all the time. These are massive, massive companies, the biggest in Canada aside from the banks. And we are telling you that you need to make these 8 changes. And if you don't make those 8 changes, it's not going to work. You're not going to have an economy.
Welcome to On the Edge. On the Edge is for educational purposes only and is not investment advice. That was David Knight-Legg. He was reviewing a letter that 38 oil patch CEOs sent to Mark Carney on April 30th with their requirements to keep the Canadian oil patch competitive on a global basis and to help kickstart the Canadian economy. Some of those requirements included the elimination of a federal industrial carbon tax, as well as the elimination of a federal emissions cap. The group of 38 also would like to see a 6-month permitting timeline for projects of national significance. We will have to see how Mr. Carney reacts. I put a challenge out to him during the campaign to speed up the Rook 1 uranium project approval process, which is facing a year of federal hearings. So far, he's not bitten at the challenge, but we'll have to see if he will now respond to the CEOs who are asking for a 6-month timeline. Fortunately, it's not all about Ottawa when it comes to the oil patch. We had some really big news coming out of the United States last week when the CEO of Diamondback Energy, Travis Stice, wrote to his shareholders saying that he believes the U.S. onshore oil industry has hit peak production. Now, if that works out to be the case, that is very big news for the Canadian oil patch, because that will encourage investors to look at Canadian companies that can deliver that last marginal barrel to the global oil market. That investors will not be able to just assume that that extra barrel is going to come from shale drilling in the U.S. So at Inc., we've been watching for Canadian producers with long life assets that have been hitting our screens. We put an example of that in the May 7th morning report, and you can actually get a copy of that if you haven't seen it already from the blog on CanadianInsider.com, so you can pick that up. And we've also written about some other names over the last few days. So make sure to check out the Inc. Research morning report, and we're going to keep our eye out for long life Canadian producers that could really potentially be in for a re-rating here as more and more investors start to believe or assess higher risks that the U.S. onshore oil industry has hit peak production. The Canadian oil patch also got a little bit of good news as well when Mark Carney met with Donald Trump in the White House last week, because Donald Trump left Canadian energy products off his "we do not need from Canada" list.
We don't really want cars from Canada. And we put tariffs on cars from Canada, and at a certain point, it won't make economic sense for Canada to build those cars. And we don't want steel from Canada because we're making our own steel, and we're having massive steel plants being built right now as we speak. We really don't want Canadian steel, and we don't want Canadian aluminum and various other things.
Shortly after he came back to power in January, the "we do not need from Canada" list did include Canadian energy products. So the fact that it's been dropped is an encouraging sign. Also, for Canada, we note that critical minerals have never been on that "we do not need" list. So we have another area of the Canadian market that's looking pretty good here. We've been writing about a generational opportunity in Canadian mining because of the demands for expanding global power grids to deal with AI power needs, and also geopolitical realities that countries need to secure their own mineral reserves and their own mineral sources. That has led to a situation where we believe we have a double barrel of opportunity here in Canada. We have the Canadian oil patch now, where we've seen insider sentiment peak in early April when stocks fell on the Trump Liberation Day tariff news. while insider buying has slowed up a bit, it is still in bullish territory. And we continue to see bullish sentiment amongst insiders in the mining group, where our diversified mining indicator is still above 300%. That means there are more than 3 stocks with key insider buying for every one with key selling over the past 60 days. The upbeat attitudes of insiders towards resources in Canada is helping to keep broad Canadian insider sentiment high. The Inc. indicator, which looks at insider sentiment on the TSX, is above 100%. So there's more companies with key insider buying than are with selling. That leads us to think that maybe the old adage of sell in May and go away is not in play in 2025 in Canada. But time will tell. So make sure to follow the insiders as we work our way through 2025. If you haven't joined us yet, you can sign up for a free intro account at canadianinsider.com and get a free starter watch list. Now, if you're looking for sophisticated tools, filtering, and data downloads, check out inkresearch.com, where you'll find tools that are not available anywhere else. Well, thanks for stopping by, and we'll see you again next time.